Financial professionals, this is exciting. If you get shivers up your spine like I do when I think of Section 7702 of the Internal Revenue Code, then you better hold on, because for the next 10 minutes, I'm going to talk about something that is very, very exciting here. By the way, my name is Charlie Gipple. I'm the owner of CG Financial Group, an IMO out of Des Moines, Iowa, and also the owner, by the way, of the Retirement Academy. If you have not gone to retirement-academy.com, make sure you go there, because when it launches April 5th, 2021, I think you will agree that from a practice management, annuity, life, long-term care standpoint, that it is will be the premier education platform in the industry. So go out there, heck, share us on Facebook. The buttons are out there to share us on not just Facebook, but social media in general, and also show us your indication of interest so that we can be in touch with you so that you're subscribed once the Retirement Academy launches. By the way, it was supposed to be March 1st. But the doctor told me that I have a procedure that I have to do, and I'm going to be out for like 4 to 6 weeks. So I better follow the doctor's orders, right? But anyway, Section 7702 of the Internal Revenue Code. This is being revised, right? It is revised as of January 1st, 2021. So the Consolidated Appropriations Act, when this was passed into law, when this was signed into law on December 27th, a lot of people didn't realize this, but as I was reading the law, I got to about page 4,900, and on that page, I'm lying. I did not really read this law, nor will I ever read a 5,000-page law. But what is in there around page 4,800 or 4,900, whatever it is that the Internal Revenue Code section 7702, it's being revised. And how important is this? To summarize everything before I actually go into everything, it is this: consumers can put more money into life insurance policies per dollar of death benefit. And by the way, why is this important? Why is this important to be able to max fund even more max than what you could max fund before? Why is this important? Because let me ask you a question here. What are cost of insurance charges based on? What are cost of insurance charges in a policy based on? Are they based off of A, or are they based off of B? Are they based off of A, or are they based off of B? Now, what is A and what is B? Kind of doing this backwards like Yoda, right? What is A? Well, A is the death benefit. Are cost of insurance charges based off of A, or are they based off of B? The difference between the cash value and the death benefit, A or B? The answer to that question is B. It's based off of the net amount at risk, the difference between the cash value and the death benefit, right? So imagine if you can put in, say, more premium, which would bring that trajectory up quicker, right? Imagine if you could put in 100% more premium. What does that do to the cost of insurance charges? What it does is it shrinks those cost of insurance charges. It makes the policy more efficient when it comes to accumulation sales, right? And that is exactly what happened with the revisions of Section 7702 that are already effective. It's just that carriers, obviously, they need to get their systems ready, maybe change products. There will be some product development that comes out. Now, is it any coincidence that whole life insurance companies almost always have a guaranteed interest rate in those policies of 4%? Is that any coincidence? No, it's not a coincidence. And let's talk about what happened here. So back in the 1980s, what happened was Congress said, yeah, if you have a life insurance with a death benefit of this, and if you put in premium of this, to exaggerate, you can't do that. You can't do that, at least you can't do that while maintaining the tax advantages that a typical life insurance policy has, right? So this is when Congress launched TEFRA, DEFRA, TAMRA back in the 1980s, and Section 7702 of the Internal Revenue Code, which was created in 1985, or it was established in 1985, right? And with these laws and this code, what came about was the 7-pay test, i.e. the modified endowment contract, the guideline premium test, the CVAT test, which basically says, yeah, if the death benefit is here, then your premium should be no more than this, whatever this is. You cannot put in this amount or that amount, right? In order for you to have the tax benefits of what a typical life insurance policy should have. So let's talk about the 7-pay level and how it's really impacted by what we had January 1st, 2021. That's already in effect again. Now, here you have the same thing, a death benefit, right? You have the death benefit going out, and here you have what your illustration system says is the 7-pay level. And what that 7-pay level means is if you put any premium in beyond that 7-pay level, it is a modified endowment contract. And by the way, what's a modified endowment contract? To simplify, a modified endowment contract takes life insurance, cash value, taxation, and it turns it into an annuity. It takes life insurance taxation and it turns it into an annuity. To simplify, it turns it into taxation like an annuity. Now the death benefit on a MEC, on a single premium life, for example, it's still tax-free. But when you look at the cash value, a modified endowment contract is taxed like an annuity. Last in, first out, pre-59.5, 10% penalties, et cetera, et cetera. So obviously we want to avoid that modified endowment contract level as much as possible, or take it right up to that modified endowment contract as much as possible. Why? Because we want to squish that death benefit and the cash value together as close as possible. So what determines these levels? What's the calculation that determines these levels? And how have these calculations, how has it changed? Well, back in the 80s, what Congress said was, so that death benefit going out to age 120, 121, whatever it is today, whatever it was back then, this level of premium, or the modified endowment contract limit, upper limit, will be how much, and no more, how much would have to go into the policy via premium in order to carry that death benefit for the life of the policy till age 100 or 121, right? What is the required premium to carry that death benefit basically forever, right? And you're probably thinking, well, it depends on a lot of things. It depends on a lot. How many premiums? The answer to that question is 7 premiums, right? Okay, so if you put 7 premiums in, what do those premium levels, what are they in order to carry the policy out until age 120 today? Back then it was different. There are other assumptions. There are expenses that Congress had to take into consideration, but the big one is the interest rate by which those premiums are going to grow by going forward. And what was that interest rate that they assumed those premiums were going to grow by going forward? 4%. 4% is what they assumed premium was going to grow by going forward. Well, here's what's happened. Over the last 35 years, interest rates have dropped. You know that the 10-year Treasury in 1981 was actually at like 15.84%, September 1981. Over 35 years, needless to say, this is long overdue. And what has happened is that 7-pay limit there, premium 1, premium 2, premium 3, to whereas if you pay more premium in than that, it doesn't have the tax advantages like life insurance should. What Congress has said with this that passed, it actually turned into law December 27th, but is effective January 1st. What's happened is, so that interest rate assumption is no longer 4%, it's 2%. And growing at only 2%, those 7 premiums, do they have to get smaller or bigger in order to hold that death benefit off until age 100 or 120 today? Not 100 then, basically, but today it would be 120, 121. And that's exactly what's happened. So today, because these are only going to grow at 2% based off the MEC calculations, the premium can be more like that instead of that. The MEC limits have gone up is what can happen, gone up 20%, 50%, in some cases 150%, depending on the age of the client. So when you think about maximum funding a policy and making policies efficient, think of that. That's what's effective today, and that's what carriers, actuaries across the country are probably pulling their hair out because they have to change their systems because, premiums have increased. Depending on age, anywhere from, 20% up to 2 or 3 times what the MEC limit was before is what it will be going forward. And by the way, whole life insurance. Think of those carriers that guaranteed 4% before, but now those guarantees are down to, say, 2%. So what you have is higher premium, because a whole life insurance policy, it's going to require higher premium with guaranteed assumptions of only 2%. But does it really change? Does it really change the profitability of the carrier? It doesn't. So what you're going to have is on the dividend side, much more, the gap between the non-guaranteed column and the guaranteed column is going to be wider than what it was before, meaning that dividends are going to become even more important going forward. Hope that makes sense. Again, you can follow me on YouTube. You can go out to Retirement-Academy. Share me on social media as well as sign up so we know to contact you prior to the Retirement Academy. And let me know if you have any questions here or I've thoroughly confused you. Have a great 2021, folks. Talk to you later.